Hello, I'm Joseph Rose, President and founder of Desert Rose Tax and Accounting, serving the business community of Southern Arizona since 1995. Now, I often hear from clients that own a business that they're afraid to show losses for more than 3 years in a row because then they'll get in trouble with the IRS. Now, this is only partially true. The thing is that the IRS would like to classify your business as a hobby, and the reason being is that with hobby losses, meaning if your hobby expenses exceed your hobby income, you're not allowed to deduct those losses. You're only allowed to write off the hobby expenses up to the amount of hobby income. Whereas with a business, you can write off all business expenses that are ordinary and necessary to offset your business income. And if you have more expenses than you do income, this creates a loss that can be used to offset other income on your tax return. It is for this reason that the IRS looks at a business that has been showing a consistent loss over time, because no legitimate business owner is going to stay in business if they continue to lose money. Now, the IRS has 9 very specific, non-exclusive factors that they look at to determining whether or not your business is truly a business or whether it is a hobby. Number 1, the manner in which the taxpayer carries out the activity. Do you operate your business as a business? Or is it just something that you do a little bit here and there on the side, like a hobby? 2, the expertise that the taxpayer has or his or her advisors. So if it's in a field that you are not an expert in, this factor would count against you. 3, the time and effort that you spend on that particular activity. Do you only spend a couple of hours a week on it? Or do you work it full time like you would a business? 4, the expectations that assets may increase in value. Not all businesses really have a lot of assets, so that may or may not apply to your particular situation. 5, the success that you have had carrying out similar activities or dissimilar activities. Have you been a successful business person with other activities or with this particular activity? Meaning, have you showed a profit? 6, the taxpayer's history of income or loss in regards to this activity. Have you shown a profit at all? Or do you consistently show losses every year? 7, the amount of occasional profits in which you earn. So if you are like some of my clients that want to show a profit one year on a business, but a small profit, this isn't very realistic. If every year you're showing $2,000 to $3,000 in losses, and then one year you show, oh, I made $1,000. $1,000 you can't really support yourself on, so this doesn't seem very reasonable to me or the IRS. 8, how about the financial status of the taxpayer? Can the taxpayer afford to lose this kind of money year after year after year? If you have large savings or inheritance or some other way to have money to offset the losses, then you're more apt to qualify for this particular factor. And 9th, the last factor, how much pleasure or recreation do you enjoy from this activity? Now, these are the 9 factors that the IRS uses to analyze each business in trying to determine whether or not the activity is truly a business or whether it's a hobby. So why don't you give Desert Rose Tax and Accounting a call for a free consultation where we can sit down and go through these factors with you and see if you can successfully meet each of these factors for your business activity. Thank you for taking the time to watch this video, and I look forward to your call.